The global financial system, long dominated by the United States and the dollar, is approaching a profound and possibly irreversible transformation. This shift is not an isolated event, but a culmination of decades of economic decisions, geopolitical shifts, and the mounting challenges of sustaining an increasingly fragile system. The convergence of these factors brings us to the brink of what many are calling the Great Reset, a complete reordering of financial priorities, power dynamics, and the instruments underpinning global commerce. At the heart of this transformation lies the massive accumulation of gold and silver by key financial players, including central banks, sovereign wealth funds, and large institutional investors. This phenomenon is not random or coincidental, but a calculated response to systemic vulnerabilities. These entities, often privy to insider knowledge and long-term forecasts, are removing precious metals from the exchanges. This action, often described as removing counterparty risk, is a signal that trust in the current fiat-based system, particularly the dollar, is eroding. To understand the gravity of these moves, it's essential to revisit how the dollar became the global reserve currency. The Bretton Woods Agreement of 1944 established a system where the dollar was directly convertible to gold at a fixed rate of $35 per ounce. This linkage lent the dollar unparalleled credibility, as it was effectively as good as gold. However, the Vietnam War and other fiscal pressures exposed the unsustainable nature of this promise. By the early 1970s, countries like France began to exchange their dollar reserves for gold, depleting U.S. gold reserves. In response, President Nixon abruptly ended dollar convertibility to gold in 1971, rendering the dollar a fiat currency backed solely by the U.S. government's promise. This created a significant dilemma. Without the gold standard, the dollar risked losing its global preeminence. The solution came in 1974 when then-Secretary of State Henry Kissinger brokered a groundbreaking agreement with Saudi Arabia. In exchange for U.S. military protection, Saudi Arabia and OPEC agreed to price all oil transactions exclusively in dollars. This petrodollar system ensured ongoing global demand for the dollar, as nations needed to hold dollars to purchase oil. This arrangement cemented the dollar's status as the world's reserve currency for nearly half a century. But now, cracks in this foundation are becoming apparent. The BRICS nations Brazil, Russia, India, China, and South Africa, along with a growing coalition of countries aligned with China's Belt and Road Initiative, are actively seeking alternatives to the dollar. Together, these nations represent over 90% of the global population and control the lion's share of natural resources. Individually, these countries may lack the economic or military power to challenge the U.S., but collectively, they are reshaping the global financial landscape. Central to this reshaping is Saudi Arabia's potential pivot away from the petrodollar. If Saudi Arabia begins accepting other currencies for oil, such as the Chinese yuan, Russian ruble, or even gold, the consequences for the dollar would be catastrophic. For nearly 50 years, global oil trade has created a synthetic demand for the dollar, ensuring its dominance despite its lack of intrinsic backing. A Saudi shift would trigger a mass exodus from the dollar, as nations would no longer need to hold it for energy transactions. This collapse in demand would cause the dollar's value to plummet. The repercussions of a dollar collapse would be swift and severe. The sudden influx of dollars returning to the U.S. as nations offload their reserves would lead to hyperinflation. Prices for goods and services would skyrocket as the purchasing power of the dollar erodes. To combat this, the Federal Reserve would be forced to raise interest rates dramatically. While this might slow inflation, it would devastate key sectors of the economy. Stocks, bonds, and real estate pillars of American wealth would collapse under the weight of soaring interest rates. The dollar's fall would thus precipitate a domino effect, wiping out wealth on an unprecedented scale. This systemic fragility is what proponents of gold and silver investment have long warned about. Precious metals are not merely commodities. They are stores of value with intrinsic worth, immune to the vagaries of fiat currencies. Gold, in particular, has been reclassified as a Tier 1 asset by the Basel III international banking regulations, placing it on par with cash and government bonds in terms of risk-free status. This reclassification underscores its importance in the emerging financial order. Central banks are not merely hoarding gold, they are preparing for a future where gold may once again underpin a new global reserve currency. A key element in this transition is the rise of digital currencies, particularly China's digital yuan. Unlike decentralized cryptocurrencies such as Bitcoin, the digital yuan is a state-controlled currency built on blockchain technology. This technology offers a transparent, immutable ledger that can verify transactions and asset backing in real time. The digital yuan is already being tested in international trade and could serve as the infrastructure for a broader BRICS currency system. Unlike the fiat dollar, a BRICS-backed currency tied to commodities, gold, hydrocarbons, grains, and other resources would have tangible value. This shift would be a game-changer, challenging the fiat-based global order. The geopolitical implications of such a shift are profound. The BRICS nations and their allies are coalescing not just around economic interests, but also around a shared disdain for Western hegemony. Even long-standing adversaries like Iran and Saudi Arabia are setting aside differences to collaborate on infrastructure projects, such as a railway linking their territories. This spirit of cooperation, fueled by the adage, "the enemy of my enemy is my friend," underscores the urgency of their collective mission to establish a multipolar world. Yet the transition away from the dollar will not be seamless. The U.S., as the issuer of the world's reserve currency, has long enjoyed the exorbitant privilege of printing money to fund its deficits. This privilege has allowed the U.S. to sustain a standard of living disproportionate to its productive capacity. A loss of reserve currency status would force the U.S. to confront its staggering debt and trade imbalances. The resulting austerity measures could plunge the country into a prolonged economic depression. The role of gold and silver in this scenario cannot be overstated. These metals represent a hedge against the uncertainties of fiat currencies and the volatility of financial markets. Unlike stocks or real estate, which are vulnerable to market crashes, precious metals retain their value across centuries. In a world where trust in traditional financial systems is waning, gold and silver provide a timeless refuge. The Great Reset, therefore, is not merely a financial recalibration, but a paradigm shift. It marks the end of an era dominated by fiat currencies and speculative wealth creation and the beginning of a new order rooted in tangible assets and equitable trade. While the U.S. and the West grapple with the implications of this transition, the BRICS nations are laying the groundwork for a system that could redefine global commerce for generations to come. This unfolding drama highlights the fragility of the existing order and the inevitability of change. The dollar, once a symbol of stability and trust, now stands as a monument to overreach and hubris. As nations move to reclaim sovereignty over their economies, the era of dollar dominance appears to be drawing to a close. In its place, a new system is emerging, one that promises greater balance, but also significant upheaval. The age of fiat dominance is ending, and the world is preparing for a golden rebirth.